Howdy, folks. It's Dr. Jeff Camardo with a quick market update based on a great Wall Street Journal article I read this morning. Today is February 8th, 2023, and I'm just going to excerpt the salient points. It's written by James McIntosh, and the title is Goldilocks Economy is a Fairy Tale Too Good to Be True. Subhead, the recent stock market rally isn't just about a new version of the not too hot, not too cold economy, but a wild race to load up on risk. It begins what investors really liked in the 1990s was a Goldilocks economy, not too hot, not too cold, just like the porridge she eats in the fairy tale. To the delight of investors, Goldilocks seems to be back in spite of full employment that ought to push wages up fast. Perhaps the Federal Reserve has it all wrong and investors are right to be pricing in both lower rates later this year and a decent economy as wage growth moderates and inflation falls. At the very least, those of us who worried that the market was ahead of itself and preparing for a soft landing need to revisit our assumptions, which, by the way, out of article, we do on a daily basis. Again, we really pride ourselves on investing not for what we think things should be or how the world should be, but what really is and what the markets are doing. So we watch and make adjustments because nobody's model of the world is right. What really tells you is what the markets are doing. Back to the article, though. Because we think that the recent market rallies, which we're trying to participate in for the short term, could be a bit of a head fake before things go much lower. Back to the article. So, according to Mr. McIntosh, the bull case is that inflation was, after all, transitory. The Fed will realize that it doesn't need to be hawkish and rates will come down without employment needing to rise much, if at all. Goldilocks says to go ahead and buy stocks. Fed Chairman Jerome Powell has stopped challenging the bulls, but however has frequently reiterated, excuse me, Jeffrey, that the strong jobs market means rates will have to be higher for longer, a message the bond market has started to absorb, but stocks seem to be ignoring because higher rates are not good for stocks, as we all know, or think we do. It is true that headline inflation is being dragged down by falling energy prices, and goods prices are coming down as post-pandemic demand returns to normal. But Mr. Powell still sees inflation danger in core services, as we do, where prices are particularly sensitive to higher wages. Mr. McIntosh says, I'm also concerned that the market has been so unbalanced. Cyclical stocks sensitive to the economy should be doing well because recession is less likely than it was, but they have rallied by far too much to make sense. Growth stocks also did well as Treasury yields dropped, which is to be expected, but then they continued up as yields rose again. Something is awry. Both Bitcoin and ARK Innovation, a proxy for speculative tech, were up 42% this year by Thursday, although they fell back a bit lately. The weakest junk bonds rose almost 9% in 25 trading days, almost matching the short-lived bear market rally that you probably remember from last summer. All this tells him that the rally isn't just about a new version of the Goldilocks economy, but a wild race to load up on risk, really without sound cause, and such bear market rallies, by definition, have a tendency to produce disappointing and sometimes calamitous results. So anyway, that's a view from a side. It kind of echoes what our thinking has been as we pilot the portfolio management board, make decisions. And again, I hope I'm wrong. I hope that this is the beginning of a very strong resurgence in stocks and your portfolios go up and our fees go up, and it just is a great place to be. But I fear the worst. And while we look to take advantage of these, sorry about the poodle, of these bear market rallies by getting in and out surgically, tactically, we don't think that it's operating yet. Anyway, that's my comments for the nonce, and I'll look forward to another chat sometime soon. Thank you so much for watching. Hope you found it interesting and useful. Bye-bye.